Okay, good afternoon everybody. How are you all today? I hope you've all had a good week in the markets, managed to catch some of those early moves at the beginning of the week. Welcome to the FX Street webinar. Of course, thank you to FX Street for putting on this event. In today's webinar, what we're going to do is we're going to talk about day trading and more specifically the way that I go about day trading. So I'm going to take you through some of my rules and everything. Once I've done that, we'll then look at some charts to see what this looks like in real life. Then we can open up the floor and you guys can ask all the questions that you like. So without further ado, let's get started. So before we go into the finer details, as always, we have to have these disclaimers. So, the content of this webinar is, of course, for educational purposes only. If you like what you see here, fantastic, but please go away, look at it for yourself, test it for yourself, and see if it makes sense to you. Obviously, spread betting or financial trading carries a high degree of risk, and it's not suitable for all individuals. So, obviously, please seek your own counsel about this before getting into this kind of stuff. So, now we've got all of that out of the way, let's move on. About myself, I can see a couple of you guys in here already, so you've seen all of this before. I'm co-founder of a website called traderscorneronline.com. It's a website I run with my brother. It's an educational website for traders, which most of us are here are. We've also co-authored a number of articles, written some books, some ebooks, all of that kind of good stuff. So if you want to find us, that is where you can go to find us and see what it is that we do. Check out our blog and all of that kind of stuff. Okay, so range bars. Now, as I said, I can see a couple of you guys in here. I can see a few familiar names and faces. So apologies if I'm going over some of the same ground, but I do think it is important just to cover some of the basics before we get into the finer details. So we're looking at range bars, which is a concept created back in the mid-90s by a Brazilian broker. Obviously, the markets were very, very volatile, and he was looking at a way to be able to make sense of the markets, and more importantly, obviously, make money of the markets. And the way he did this was to eliminate the time aspect from the charts. Okay, so he wanted to eliminate the noise, and he did that by focusing purely on the price action. Now, obviously, we see price action written all over the internet. Price action is the way to go. And to a degree, that's correct. And for me, range bars show exactly that. They show you the pure price action. They show you what price is doing, where all of the levels are. And it, from my personal perspective, it just allows us to focus on a much cleaner chart, and the entries, therefore, are a lot easier to spot. Okay, so a range bar chart, what that is it's a series of candles on a chart that are not based on time. They're based on a price, on a predefined price. So, for example, in the charts you're going to see today, we're going to be looking at the intraday chart, and we use an 8 range for that. Okay, that means every candle from high to low is going to be 8 pips. Okay, and we'll show you an example of that in a second. So if you can see this in front of you here, this is a copy of one of the intraday charts. Okay, and as you can see from high to low, all of these candles here, they're all exactly the same size. And I don't know about you guys, but for me, this clears things up a whole heap, and it makes spotting the trades and trading the trends a lot easier. My brother and I, we love trading the trends and swing trading. We aren't really people that like to trade in congestion type markets. So charts like this make it a lot easier for us to be able to trade and obviously to profit. So let's talk a little bit about the difference between range charts and time-based charts. Now, obviously conventional charts in the FX arena are time-based. You will get some charts which are based on volume, like tick charts, but for me, that doesn't really make too much sense because there is no centralized exchange in the FX market, so I'm not entirely sure where they're getting the tick data from. But anyway, so the majority of the charts are time-based charts. What this means, some of the problems with this is during quiet periods, like the Asian session, you're going to get charts, you're going to get bars printing, okay? and nothing significant needs to happen for a new bar to print. All it needs to do is go, if you're on a 5-minute chart, it needs to go from 04.59 to 5, and suddenly you have a new bar. And what that does is it makes your charts quite noisy. So when you're going for a range bound period, when not all that much is happening and just the market's just sitting in this little tight range, you're getting all of these candles printed, but they're not telling you much. I mean, all they're telling you is that there's nothing to do here. And the problem with that, especially for new traders who don't really understand how to read the charts and how to read candlestick patterns, is it makes it very messy, and messy charts make it a lot harder to make the trading decisions. All of us, Harry Hindsight is the best trader in the world, right? If you look back on a chart, you can see all of the right setups that you should have taken. But when you're in the heat of the battle and you're at the hard right edge of the screen, the last thing that you need is a disgusting, ugly chart. And unfortunately, that's what time-based charts tend to do. Okay, so as I said, nothing significant needs to happen for a new bar to print. And also, indicators can sometimes get a little bit skewed if you're using indicators on time-based charts, and you have certain momentum indicators in there, and they'll start to read the Asian session, which is typically a low volatility session. And that will kind of get some of your indicators out of whack. It's not necessarily saying that there's no volatility in the market. It's just the market's closed for all intents and purposes. During Asia, rarely does anything happen. Sometimes it does, okay, but not all the time. So that's another little issue there that I personally find with them. I mean, if you guys are doing well without these, then fantastic. I'm not saying that time-based charts don't work. I'm just trying to help you guys who may be struggling or looking for something a little bit different, just to see the light that I see. So anyway, that's time-based charts. Range bar charts are price-based. So each bar on the chart is exactly X pips from high to low. And the X pips, as we've said before, is whatever you define. So that can be 8 pips, it can be 10 pips, it can be 15, 20, whatever it is that you're looking at. Generally speaking, I mean, if you want a scientific way to work out the right number of pips for a particular chart, so let's say, for example, you're used to trading an hour chart, but you want to switch to the equivalent of an hour chart on a range chart, what you might want to do is pull up like an ATR indicator, so an average true range for the hour bars, and put that back, 300, 1,000 bars, and get an average and use that as your range for the hour chart. Me personally, when I'm looking at charts, I like them to be aesthetically pleasing. So I'll go through, I'll start 5, 10, 15, 20, and just go through there to see what sort of looks right to me, what I can see clear tradable opportunities from, and then I'll refine it from there. So a range chart, as we said, it's a candle that from the high to the low is a specified, predefined amount of pips. Okay. Now, what this means is if the market is consolidating, you're not going to see that many bars printed. And that's fantastic for me, because if there's nothing happening, I don't want to see anything. Okay. Some people, I've even had these debates with my brother who, he believes when you're trading longer term, he likes to see the candles where there's nothing happening, because it kind of gives a story of the overall price. And that's fine. That's fine for some people. But personally, especially for intraday stuff, I don't believe that that's completely necessary. For intraday stuff, what we want to do is we want to see a trending market, and we want to jump in there on the trend, and we want to make some profits. Okay, I don't really care about, haramis or dojis or whatever, not bothered. I just want to see the price react to a predefined level of support and resistance, give me an entry to get in, and allow me to get in there and get my profits. So, as we said, the market, if it's consolidating, you're not going to see many bars printed, and as a result of that, it eliminates a lot of the noise on the charts. Okay, so by doing this, we're not going to have as noisy charts as you would with a time-based chart. I believe it helps to identify trending markets very, very well, because obviously, if you're not seeing the consolidation zones, what that ultimately means is you're only really going to see the trending markets. Okay. And it allows for earlier entries and pure price action based entries. I'm going to clarify this a little bit, because what I'm trying to say here is if, there are some traders out there that wait for a candle to close or something. And the problem with waiting for a candle to close is that if you're in a particularly volatile time and the market's really, really fast moving, then you may get a candle close which is already closed beyond your take profit point, or you get in a little bit later than you would have liked because you're waiting for a candle close based on time. And in that 5 minutes or 10 minutes or an hour, the market can do a lot in that time. Whereas with the range charts, the candle close, if you're waiting for a candle close, is only going to be X pips more. So if you're on an 8 pip chart, your candle close will be in 8 pips time. Okay, so you're never going to be more than that like you are on a time-based chart. I hope that makes sense. Did that confuse anybody, or are you all following me so far? Maybe, could be, should be. I will take silence as agreement then. Clear, excellent. All right. So let's have a very, very quick look at the candlesticks here. On the left, you have a typical time-based candle, okay? Now, what I want you to notice about these two candles is the fact that on the time-based candle, the open and the close can be in the middle of the candle, okay? So you can have wicks either side. On a range chart, that's pretty much impossible. The reason for that is that the next candle opens once the range for the previous candle has been exceeded. So if we're on an 8 range chart, take a look at this candle here. This is a bullish candle, right? This candle would not close until, let's say this is 8 ranges. So this is 1, 2, 3, 4, 5, 6, 7, 8. This candle is not going to close until 8 pips are exceeded. So therefore, it could never come up to, let's say this is 7 pips. It could never come up to 7 pips, go back down to 6 or 5 pips and close. It has to close at the high or the low of the candle. Okay, whereas with time-based charts, as we said, this could be an hour's worth of information. So the market here has gone up. It's found some resistance at the top. It's come down and it's closed somewhere around the top of the candle, but not at the very top. Okay, so that's, I mean, that should be pretty obvious, but just in case, when you look at your charts and you see that you don't really have wicks either side for all of your candles, that would be the case. Okay. So let's talk about the system itself. We're going to call it the TCR system because it sounds cool. What it actually stands for is Traders Corner Range Bar System. But anyway, so we'll call it the TCR system. What it is it's a swing trading system. Okay, it's price action based, which is important. It's got a positive risk reward, which is very, very important. Now, I know people can make money with a negative risk reward. They just have an obscenely high strike rate. But for me personally, I prefer trading systems where you don't have to have, you know, as I said, a ridiculously high strike rate. I like to know that I can make stupid decisions because we're all human and we all do make stupid decisions from time to time. I like to know that I can do that and it's not going to affect me too much. And having a positive risk reward allows you to do that. Okay, so this system is, you have a positive risk reward with that. It's very fast paced when the markets are moving. So you need to, you know, you don't have the luxury of saying, okay, this 5-minute candle's just open or this 15-minute candle's just open. I'm going to go away, make a cup of tea and come back in 15 minutes time. Because with price action bars, okay, where was I? Yes, it's fast paced even, which ultimately means you can't sit there, look at your chart, see that the 15 minutes candle has just opened up, walk away, make yourself a cup of tea because I'm English, come back to the chart and, you know, 15 minutes later, then make your decision. When you're looking at these range bar charts on an intraday basis, you need to be in front of your screen when a setup looks like it's about to happen, because the moment that you get up, and believe me, I've done this myself, got up to walk across the office, come back 2 to 3 minutes later, and I find that actually the move just happened and I've missed my profit target, and then I hate myself. Okay, so don't do that. So it's very fast paced. It allows you to focus on one pair. Now, why am I saying this? Because a lot of times I hear a lot of conversations about, okay, this system's fantastic, wonderful. If I add 6 pairs to this or 10 pairs, then I'm going to make so much more profit. Now, unfortunately, trading doesn't really work like that, because you know what happens when you add 10 pairs? First of all, you end up being in 10 of the same trades, okay, because you could be trading 10 correlated currency pairs, or maybe even worse, you decide to focus on a particular pair which ends up not moving. So you take the trade on one pair, you miss the trade on the other. The one that you took doesn't make any sense and it doesn't move anywhere. The one that you missed ends up making the money and would have hit your profit target. So you can't really get much consistency there with that. Okay, so by focusing on one pair, you get to be an expert with that one pair. Okay, you don't need more. We're lucky enough to be trading the Forex market, which means that all we need to do is increase our size. Okay, we're never really going to get to a size where we're going to affect the marketplace. So we can afford to focus on the one pair. And once we get really, really good at trading that one pair, we can increase our size. You don't need to, look for other pairs to look for more trades, because ultimately as FX traders, we're looking to make money, right? And by increasing the amount of pairs that we're trading, we're also increasing our cost of doing business, because you're then paying commission on each and every one of those pairs that you enter. Every trade that you enter, you're paying the spread. So why pay the spread on all of those pairs when you can just focus on one, become a master of one, and pay lower commissions? Okay? And it's about trading is really about quality. It's not about the quantity. It's not about trading, 4 million times a day just because you're bored. It's about trading the very best setups and making money on the very best setups. Okay? Does that make sense to you guys? Now, trading this system, you get on average 2 trades per day. Some trades you get none. Some trades you get 4 or 5. But if you work it out over a period of a couple of months, you'll see that it works out somewhere between sort of 1 to 3 trades a day. So we'll call it 2 trades a day. You're never going to carry a position overnight. All right. So I know a lot of people like that aspect. So you're not going to have to go to sleep worrying what the market's going to do. Your trades will be closed during that day at some point. Something that you need to be wary of is that you are subject to event risk volatility. So you do need to take into account the news. Now, when we're teaching some of our members about the longer term trading, we're not as bothered about some of the big news announcements or the mediocre news announcements, because we're trading on a longer term perspective, and 20 pips swing here and there isn't really going to affect our position, because we'd have stop losses of 100 pips or so. When you're day trading, particularly this system, your stop is about 10 pips. Okay, so you need to be wary of the news that's out for that particular day when it is, because you don't want to be getting into a trade, because if the market sneezes based on a news announcement, just goes the wrong way for a split second, you can be whipped out of your position, and you don't want that. Okay, so you need to pay attention to that. Also, it's almost purely mechanical, the system. There is some discretion involved, but we've got some filters here and there which kind of tell you when to and when not to get into the trade. So you still have to use your brain, unfortunately, a little bit, but for the most part, all of it's there set up for you. You just need to decide when to enter and when to exit. But with regards to looking at the setups, the types of setups that you're looking at, it's very, very straightforward. And at the bottom there, I've put this used for income. I'm not sure if I should have put that there. Maybe we need a disclaimer for that as well. But what I'm trying to say is that day trading, you can use day trading to generate your. Can you return to positive risk reward? You were disturbed. Yes, I'll get back there in a second, Boyke. So used for income. What I'm basically saying here is longer term trading. Okay, you need to have a much bigger bank, because you need to withstand obviously bigger swings in the market, and you can't necessarily be trading a longer term system where you've got 100 pip stop or 200 pip stop if you've got $1,000 account. It just doesn't make sense. So you need a bigger account to be able to do that. So you generally trade longer term systems for capital growth, whereas we see with the shorter term systems, you can kind of use that as your high risk basket. Okay, so with your high risk basket, you can say, I'm going to put $1,000 into this account, and no one wants to lose $1,000, but you can now afford to bet a little bit bigger to generate that sort of daily income. Actually, daily income is the wrong thing to say. I wouldn't encourage anybody to look for a daily income, but let's say sort of weekly and monthly type things there. You can use a shorter term system for that. So I hope that makes sense. Boyke, going back to the positive risk reward. What I was saying there is it allows you, with a positive risk reward, what that allows you to do is make mistakes. Now, none of us like to make mistakes, but we're human beings and we do make mistakes, whether we like it or not. Okay? So having a positive risk reward, let's say for example, you have a risk reward of 1 to 2. So for every 1 you risk, you can afford to make 2. All right. Let's say for example, you see a setup. You take that setup, you lose. So you've lost 1. The setup presents itself again. You take it again, you lose. So you've lost 2. Setup presents itself again, you take it and you win. Okay. Now you're back at break even. So suddenly what you've got with around a 2 to 1 or 1 to 2 risk reward is you're allowing yourself 3 bites at the cherry every single setup to be able to get yourself back to break even. So if you make a stupid decision and you're in there too quick or you're in there too late or something like that, it does matter, but it doesn't matter that much because you're giving yourself a second chance at the trade. Does that make sense, Boyke? Shall I? Yeah? Wonderful. Okay. The trading times. Now, the trading times for me, and these are UK times, so I'm looking at 8 a.m. in the morning to 11 a.m. That means I don't take a trade before 8 a.m. and I don't take a trade after 11 a.m. All right? Because when it gets to that sort of time, the markets tend to do absolutely nothing apart from just wind you up. Sometimes you will see moves, but you need to be ready for that. You need to understand, as a trader, you're not going to get every single move in the market. The best that you can do is define some rules, which I'm giving you here, and be consistent in executing those rules. From when you're consistent executing those rules, then you can be a consistently profitable trader. But you need to understand that you're going to leave some moves on the table. So by stopping trading at 11 a.m., you will see on the odd day the market continue and give you other opportunities. But that's just something that you need to accept. You can't get into the habit where suddenly you're seeing these moves and you think, you know what? 11 a.m. I'm going to trade until 11:30, and then I'm going to trade until 12 o'clock, and then I'm not going to take a lunch break. I'm going to trade the whole day. We need to be realistic with this, okay? Yes, we want to make money trading in the markets, all right? But at the end of the day, you're still a human being, and you're going to need to go to the bathroom. You're going to need to eat lunch. You need to be in peak condition to be a good trader, to be a consistent trader. So you need to put these parameters into place. So we trade 8 a.m. in the morning, UK, to 11 a.m. and 1 p.m. to 4 p.m. UK time in the evening. The chart setup. Okay. Now on the charts in a second, 2 hour lunch. Yeah, 2 hour lunch, go to the gym. George, that will be British BST in the summer and obviously GMT in the winter. So UK time. 2 hour lunch. Yes, we like our 2 hour lunches. All right, so we're going to the chart setup. Now, one thing, hold on, is this new platform or can we use existing trading platform too? Yeah, of course, you can use everything that I'm showing you here. What we're not trying to do here, we're not one of these companies that say this is a fantastic magic system, but you need to buy our magic indicators to allow you to be able to trade it. What we're showing you here is available on every single trading platform. Having said that, there are 1 or 2 filters which we do have for our trades, which I can't really disclose here because we give it to our members and I don't feel it will be fair on the rest of our members if I give all of this away for free and they're paying for the privilege of it, okay? But having said that, everything that we do use it's not a special magic indicator. It's something that you can find on every single trading platform. Apart from range bars. Range bars, you may need to find an indicator somewhere if you're using MetaTrader. We use NinjaTrader for our range trading, but if you use MetaTrader, you'll need to find like an indicator or an expert advisor or something like that. They are available out there, so if you Google it, or maybe somebody in the room here will know of a good download link, maybe they can provide it to you. Okay, so the setup, intraday, 8 range chart. Okay, so we're looking for 8 pips for the range. We're using 3 moving averages. We're using the 20, the 60, and the 100 exponential moving averages. Okay, what do the moving averages do? They give us permission to get in, they give us permission to look at a trade. Absolutely nothing more. All right, it's not saying you have to get into a trade here or whatever. It just says, you know what, now's a favorable time. You can look at the markets right now. Okay. The other thing is daily pivots. We use the daily pivots as sort of support and resistance. So with support and resistance, you wouldn't ever trade into a big level of support, but you look to trade bounces off of support. We use pivots the same way. So you'd never trade into a pivot point It doesn't make any sense because the markets tend to chop around there. And yesterday was a prime example of how the pivots kept us out of two ridiculous trades. You know, we've got two signals to enter, but because we were trading directly into the pivot point, we didn't take the trades, and thankfully that saved us some money. All right, so we're using an 8 range chart, 3 moving averages, and the daily pivots. Let's move on to the next slide. Entry rules for a long entry. The moving averages have to be pointing up. That means the 20 is above the 60 and the 60 is above the 100. That means you have permission to look at a chart. Now, I'm going to add a caveat here. If you're more experienced and you understand support and resistance and things like that, then sometimes you can ignore the fact that the moving averages aren't lined up. If it's bouncing off of like a major level of resistance or a major level of support, and it's just sort of kind of obvious as to what the market's going to do, then for those points you can ignore the moving average rule. But if you're new to trading, then it's probably best just to stick with this rule. Make sure that the moving averages are lined up before you even look at taking the trade. Okay, so 20 above the 60, 60 above the 100, permission to look at the trade. What we're looking for is we're looking for a trending environment, which is signaled by the moving averages. Once we've got the trending environment, we're looking for the market to pull back to a previous level of support or resistance. And we'll show you what that looks like on some slides in a second. So we want the markets to be breaking out to new highs, and we want them to pull back to a prior level of support or resistance, which is where we look to take our trade. We're not looking just to trade every single pullback in the market because sometimes they don't make sense. The ones that make sense, the high probability, the high quality setups, are those that come back to a predefined level of support and resistance. So we're looking for the pullback to support or resistance. Now, looking for a long entry, the setup candle must be a bull candle. Okay, so that means that you can't consider that you're having a bounce off of a support level if it's a bearish candle. It doesn't make any sense. That's never bouncing. That's trying to break through. So it needs to be a bullish candle. Okay. You must have at least 1-to-1 risk reward, including your spread, before the next pivot level or next major level of support and resistance. If you can't get 1-to-1 before entering it, then don't enter the trade. We're always looking for positive risk reward. Okay. And then you enter on the open of the candle where all of the above conditions are true. Okay, so once you've got the pullback, you've got the moving averages lined up, you've got the pullback to a previous level of resistance, you then get a positive close off of that level, the next candle is where you enter the market. Okay, similarly, for short entries, moving averages are pointing down. The 20 is below the 60, the 60 is below the 100. That means you have permission to look for a trade now. You're looking for pullback to previous levels of support and resistance. Again, we're only looking to trade the highest probability trades. We're looking for quality trades, which means we're looking for levels of support and resistance that the majority of the market can also see, because that gives us a better chance of making money on the trade. You must have at least 1-to-1 risk reward for the next level, and it must be a bear candle. So it needs to be a negative candle close for you to enter on the short side. Once you get those conditions, you enter on the open of the very next candle, and you look to make some profit. You look to make some money. Okay? Exit rules. Stop behind the setup candle. So generally, the candle that gives you the setup, say, okay, next candle, enter. You want to put your stop below there. So that's about 10 pips with a broker with a 1 pip spread. All right? So you're looking at 8 pips for the range, 1 pip for the spread, 1 pip for the open of the other candle. So it's about 10 pips. And generally speaking, your profit target, you're looking for 2-to-1. So you're looking for approximately 20 pips, okay, of a profit target. Now, obviously, if you're trading up to a level of support or resistance and you only have 15 pips or 16 pips on the table, watch to see how the market reacts to that level. If it looks like momentum's fading from the market at that time, just jump out. Jump out of the market with your profit, okay? It doesn't need to be 2-to-1. It's just nice to have. Okay, what does that look like? So this is what it looks like for a long entry. Okay, you can see here with this blue line, we've got the market is moving up. Well, we've got the trend up, we've got the moving averages pointing up. So we've got the 20 above the 60, the 60 above the 100. Wonderful. The market rallies up, it breaks through these highs here, then pulls back. look here, we don't take this trade here. First of all, our filters down here don't allow us to take it. But secondly, you're not at the support or resistance level. You're not at this previous level of support. So why would the market bounce off of that level? There's no reason. So we don't want to look at it. Now the market comes down. Aha. The market's at this previous level of support. Now the market has a reason to start to bounce off of this level. The rest of the market participants can probably see this level as well. So if the market starts to bounce off of this level, then it's a pretty good indication that you're going to get some sort of a move off of there because you've got the reason. Okay, so it's also very close to the pivot point. So that's a great trade. That's one that you want to look to take there. All right, the short, let's see what it looks like for a short. Again, the market's in a downtrend, moving average is pointing down. Wonderful. We draw in a previous level of support here. We put this all the way along. Now we're waiting for the market to pull back to it. So the market starts to pull back. We get the first negative close there. Do we take that? No. Why? Because we're not at the previous level of support or resistance. Also down here, we're kept out from our filters, which is nice as well. But we don't get the entry. Finally, we get the trend line break here. The market's bounced off of support and resistance. You can be in there on that candle, stop above it, and you can trade it down. Does that make sense to everybody? I know that I've just spoken at you for must be 32, 33 minutes now, so apologies for that. But I wanted to get it all out so that I can open up the floor for some questions and answers. That brings me to the end of the presentation. Does it make sense? How do you guys feel about that? As I said, I want you guys to go away and try it for yourselves. I want you guys to understand it and to see that it makes sense for yourself. Go back and back test it. You'll be very, very impressed with the results for it. But don't take my word for it. Okay, I could be anyone. So don't take my word for it. Go away, test it, see what you think. And, you know, if you do it according to these rules here, I'm pretty certain you're going to be very, very pleased with the results. So, any questions, anyone? I'm not convinced I took a breath in that whole 30 minutes, so it's nice to breathe again. Why 8? Because that's a number that I found, Boyke. Sorry, I'll answer your question in a second, James. That's a number that I found that got you into the intraday moves, but kept you out of some of the noise. So it just seemed to make the most sense. But please feel free to test other ranges. 8 just seemed to be the one that worked. I looked at a 4. Well, 8's a lucky number for the Chinese, isn't it? And I'm half Chinese, so maybe. But no, I looked at a 4, a 5, a 6, a 10, and 8 just seemed to work well. In answer to your question, James, yes, we have back tested the strategy. We've also forward tested it a little bit. I'm not sure if we're allowed to give results or things on here. Can one of the FX Street admins let us know if we can give some of the results or some of the back tests on here? Try and Trader, I think this webinar is going to be recorded, so it will be available for you to watch later. We've actually covered quite a lot of information, so it may be difficult to quickly summarize. It's a general question for you. How crucial is one's choice of broker? Are you the main ones in the UK, or are the main ones in the UK basically similar? Yes, it's Pitman. Yes, it's close to a 5-minute candle. The ones in the it is quite an important decision choosing your broker, because at the end of the day, your cost of doing business, it will have an impact on your profitability as a trader. So if you're with a broker, trading this system here, you want to be with a broker who offers you like a 1-pip spread. If you've got any more than that, then not that you'll have a problem making money, but it'll just be a little bit more difficult. Okay. If you're trading longer term, then the spread doesn't matter as much because you're going for much, much bigger moves. So if you've got like a 3-5 pip spread and you've got a 100 pip profit target, then, that's just 5% of your entire profit target. So that doesn't really mean a lot. Whereas if you've got a 2 pip spread or a 3 pip spread and your profit target is, 15 pips, for example, then it's considerably more percentage, a much bigger percentage than that of a 3 pip on a 100 pip. No, I don't trade ranging or sideways pairs. I try not to. Did we get any feedback, FX Street, Maud or Vicky or Adinda? Any feedback on whether we're allowed to produce the results. Of course, James, that is very true. But at the end of the day, I'm not sure. We're not regulated or authorized by the FSA, so I'm not entirely sure what that means. That makes. Do you trade indices using? Okay, hold on 1 second. Do you trade indices using this? Yes, you can do. You can do. I've looked at the Nasdaq. You can also trade stocks. This works wonderfully. If you've got a big enough account to trade something like Apple, take a look at Apple. Using this, it wouldn't be an 8 range. I forget. You'd use like a 50 range on Apple. But look at Apple for intraday trading on that. You will love it. I actually use a spread betting company. Well, we use FXCM as our broker for our longer term trades, but for the shorter term trades, I actually use a spread betting company here in the UK. $16, Boyke. Sorry, I don't follow. I've lost it. Maud, the question was, am I allowed to give results of trading this system? Okay, excellent. Yeah. Okay, James, so basically trading the system, both back and forward testing results, you average, if you're risking, let's say 1% a trade, and everybody's risk parameters are different, but we'll do it on percentage basis. You risk around 1% a trade, then you can expect to make between 10 and 20% a month. If you trade it accordingly, if you trade it according to the rules and everything. Okay, now that's a lot, so you might want to take less of a risk to, obviously make less. It depends on your risk parameters. But 1% a month, you can expect to make anywhere between 10 and 20% a month. On an average month, and on a fantastic month, then you can look to make considerably more. But as I said, please go back and test it for yourself, James. Okay, honestly, don't take my word for it. Test it for yourself and know that makes sense. Okay, so you need to be able to spot the setups as well. So go back, have a look at it, and see if it makes sense for you. What offline time frame do you use? I don't use an offline time frame, George. Do I only? Yes, day trading. I only trade this way. This is my favorite way to trade at the moment. I use IG Index as a spread betting company. I don't really use MT4 that much anymore. I use MT4 for some of the longer term stuff because you can look at it offline and it's quicker. But for the majority of my trading, and certainly for my intraday trading, I use NinjaTrader. That's a combination of both, James. No, Carly, you don't need any additional indicators to trade successfully. You do need to be able to have access to range bars, and I think you'd need to find that on the internet somewhere if you're going to trade with MetaTrader. I trade with NinjaTrader, and that's provided as standard. Okay, so nice, wonderful. The indicators you see at the bottom are the stochastics and the CCI. As I said, unfortunately, I can't really disclose exactly what we do here because I don't feel it would be fair to the rest of our members. But you can see it on the bottom. You can see it on the bottom of the chart there, and you can see the green vertical line there on the chart. So I'll let you kind of make sense for yourself what that may or may not mean. If that makes any sense. A little tip, a little clue there. Do we have a live trading room? No, we don't. It's something that we want to do, but as I said, we're based in the UK and we're not authorized or regulated by the FSA. We had a conversation with them a couple of weeks ago about such a thing, and that would kind of go down the rules of investment advice, which we're not authorized to do. We are looking at starting some sort of a trading room where we can, just sort of like a community, so we can talk about trades together, we can analyze them after the fact and all of that. But we can't specifically say buy here, stop here, profit target here, etc., etc. Boyke, you can hold overnight if it's going well. Of course you can, but I'm just saying that with the rules that we've given you, you wouldn't be holding overnight. But if you're one of these people that can hold on to a position, which is a very, very good quality to have as a trader, then by all means hold it overnight. Yeah, they're just standard, Carly. They come with the session on NinjaTrader. You have session templates, and the FX template, I believe it works it out on the New York close. Any other questions, anyone? Okay, man, I'll clear this up for you. Basically, first of all, okay, big funds, and I can tell you this from experience, big funds, if you make more than 20% a year, right, investors are scared of you because big funds have institutional money, so they have pension funds and things like that. Trading to make 10 to 20% a month means that you can lose 10 to 20, 30, or even 40% a month. That's just the risk of trading. It's give and take. You can't have that kind of reward without that kind of risk. Now, big funds and everything, they won't tolerate, their investors aren't going to tolerate 20% risk a year. They'll need volatility, like a peak to trough drawdown of, in the single digit percentages. If they start to get into double digits, then it's very, very difficult for them to get institutional money. Does that make sense? So that's, and do you know what? I had the same question as you, because when I first came to this, I was just looking for, 30, 40, 50% a year. When we were doing 50% a year, a couple of years back, we were more than happy. Okay. That we're like, yay, 40, 50% a year, happy days. But we were in the mindset of trading as a big fund when we needed to get into the mindset of understanding as a retail trader, you can be a little bit more nimble. Now, obviously, as I said, you need to decide on the risk for yourself because risking 1% a trade, let's say, for example, you have three trades in a day, all right, and you go 3 trades and you lose 3 trades in a row. That means you've lost 9%, all right? You've lost 9% of your bank in 3 days. Now, big funds, that's a lot harder for them to explain to their investors, whereas you as a private retail client, you may be happy with that. You may be happy with losing 9% in 3 days. Okay, so it swings and roundabouts. Does that make sense to you? No, I don't use Bollinger Bands, Ted. Camarilla pivot points. I just use the plain vanilla pivot points, George. But yeah, I would imagine so. Give it a go. Have a look. Any other questions? Oh, and the other thing regarding risk reward, guys, I think I've said it before. Read this book. Okay, I'll see if I can type it in here. Read this book. Pitbull. By Marty Schwartz. Pitbull by Marty Schwartz. Read that book, okay? Oh, Marty. Like that. Yes, James. Fantastic book. That guy there, average, he's a trader on Wall Street from sort of like the early 80s, maybe late 70s. And he averaged about 20-25% a month. So that's what's possible as a day trader if you get it right. But it's not easy. Okay, it does require work. If you want to trade hold longer term, what would be the range bar size? For the longer term stuff, we use sort of 50 range bar and a 25 range bar. Do I trade Mondays and Fridays? Yes, certainly. Not a problem with it. Brokers we work with, FXCM and IG Index. They are two completely different things, but you as a person have a big say in which one it is. Okay, so it's very possible, probable if you can, I mean, it's such a cliche, but it's so true. If you can control yourself, then it makes it a whole heap more probable. Because, James, if you go back and you test and you back test this, right, as I'm saying that you should do, you go back and you back test this, you'll be astounded with the results. Now, Can you replicate that in the real trading environment? I don't know. But you will see that it does work. Now, what I encourage everybody here to do is to keep 2 trading diaries, okay? So you have your trading diaries for the trades that you do, so your trading journal and spreadsheet or whatever for the trades that you actually execute. But next to that, keep another trading diary for the trades that you would take in hindsight, okay? So at the end of every day, say, okay, I took A, B, and C trades. They're the ones that I actually took. And then look in the trading diary, and in the trading diary, with hindsight, say, well, actually, there was A, B, C, and D, or there was only A and B. C didn't occur. That wasn't a real trade. And then start to tally those up at the end of the month or at the end of the week or whatever, and you'll start to see a pattern. Because what I don't want you guys to do is to be discouraged from something, think, oh no, this doesn't work. When actually it's not that the system doesn't work, it might be that you're the thing that's not working here. You're the aspect, you're the factor here that's not working. So it's very, very important. And I would encourage every single person here to keep 2 trading diaries, okay? So the one for what you're actually doing and the one for at the end of the day when you don't have any money on the line, you're thinking rationally, and then you can compare the 2. And that way you can see for sure whether the system's working for you or the system's not working for you, or whether it's you yourself as a person that's not working. The best times to trade, I trade between 8 a.m. and 11 a.m. and I would say between 1 and 4 p.m. UK time. Yes, indeed, James. Asia is very, very quiet. So any other questions? Have you all enjoyed this session? The euro dollar for this boy key. Euro dollar. Do you deal with the noise? I use range charts. That's how we deal with the noise, try and trader. Range bars eliminates a lot of that noise. Probably in the pub having a pint by 7 p.m. Yeah, but I don't drink. If I drank, yes, I would be, but no. But you can corrupt me if you like, James. My wife would like that very much. She's been trying it since we first got married, so. Excellent. Yeah, guys, I encourage you. Everybody go away and see what you do. Excellent. So should we wrap it up here then, FX Street? Excellent, people. Thank you very much for attending, and I hope to see you all on another webinar at some point. The site is traderscorner-online.com. I'll type it in here. Ciao for now, people. Goodbye. Thank you.